Investing in real estate can be life-changing, building long-term wealth and financial freedom. But it's not about gut feelings. Success in real estate investing starts with understanding the numbers. Analyzing potential rental properties isn't just for experts, it's a crucial skill for every investor, especially beginners. Before you invest a single dollar, you need a clear picture of your potential investment's financial health. This means understanding key financial metrics and how they apply to your specific property. By mastering these concepts, you equip yourself to make informed decisions, minimize risks, and maximize returns. This knowledge empowers you to confidently assess potential deals. You'll quickly identify properties with strong income potential and steer clear of those likely to drain your resources. Remember, knowledge is power, and in real estate, that knowledge translates directly into financial success. 3 key metrics form the foundation of your real estate analysis: cash flow, capitalization rate, cap rate, and return on investment, ROI. These interconnected measures provide a comprehensive view of a property's financial performance. Cash flow represents the lifeblood of your investment, indicating the income remaining after covering all expenses. Positive cash flow means your property generates more income than it costs to operate, putting money in your pocket. Cap rate offers a snapshot of a property's potential profitability by comparing its net operating income to its market value. It helps you quickly assess the investment's potential return relative to other opportunities. ROI measures the overall profitability of your investment over a specific period. It considers both cash flow and property appreciation, giving you a complete picture of your investment's performance. By understanding and analyzing these 3 metrics, you gain a powerful toolkit for evaluating rental properties and making informed investment decisions. Cash flow is the cornerstone of successful rental property investing. It represents the net income generated by your property after deducting all operating expenses from rental income. Positive cash flow signifies your property is profitable, while negative cash flow indicates you're losing money. Calculating cash flow is straightforward. First, determine your gross rental income by multiplying the monthly rent by the number of units, and then by 12 for the annual income. Next, subtract your operating expenses, including property taxes, insurance, maintenance, utilities, and property management fees. For example, imagine a duplex generating $1,000 in monthly rent per unit. The annual gross rental income would be $24,000, $1,000 per unit times 2 units times 12 months. If annual operating expenses total $8,000, your annual cash flow would be $16,000, $24,000 minus $8,000. Positive cash flow provides financial security, allowing you to cover mortgage payments, reinvest in your property, and build long-term wealth. Therefore, prioritizing properties with strong potential for positive cash flow is crucial for your investment success. The capitalization rate, or cap rate, provides a quick assessment of a rental property's potential profitability compared to other investment opportunities. It's calculated by dividing the property's net operating income, NOI, by its current market value. To calculate the cap rate, first determine the NOI, which is the annual rental income minus operating expenses. Then, divide the NOI by the property's market value. For example, if a property generates $20,000 in NOI and has a market value of $400,000, the cap rate would be 5%. $20,000 divided by $400,000 equals 0.05 or 5%. A higher cap rate generally indicates a better investment opportunity, suggesting higher potential returns relative to the investment amount. However, remember that cap rate is just one factor to consider. Other factors like property condition, location, and market trends also play a crucial role in your investment decision. By comparing cap rates across different properties, you can quickly identify those offering potentially higher returns on your investment. This allows you to focus your analysis on the most promising opportunities and make more informed decisions. Section 5. ROI measuring your return on investment. Return on investment, or ROI, measures the overall profitability of your real estate investment over a specific period, typically 1 year. It considers both cash flow and property appreciation, providing a comprehensive view of your investment's performance. To calculate ROI, first determine your annual net profit, which includes both cash flow and any increase in the property's value. Then, divide the net profit by your total investment cost. For example, if your property generates $10,000 in annual cash flow, appreciates by $20,000, and your initial investment was $100,000, your ROI would be 30%. That's because $10,000 plus $20,000 divided by $100,000 equals 0.3 or 30%. A higher ROI indicates a more profitable investment. However, remember that ROI is influenced by various factors, including market conditions, property management, and economic trends. Therefore, it's crucial to analyze ROI in conjunction with other metrics and consider the broader market context. By tracking your ROI over time, you can assess the long-term performance of your real estate investments and make informed decisions about holding, selling, or refinancing your properties. Even with the best intentions, beginners can fall prey to common mistakes when analyzing rental properties. Being aware of these pitfalls and understanding how to avoid them can save you time, money, and potential headaches. One common mistake is underestimating expenses. Unexpected repairs, vacancy rates, and rising property taxes can quickly erode your cash flow. Always factor in a buffer for unexpected costs and conservatively estimate your expenses. Another pitfall is relying solely on projected numbers. While future projections are helpful, basing your analysis solely on optimistic assumptions can be misleading. Focus on current market data, comparable property performance, and conservative estimates. Lastly, neglecting thorough due diligence can lead to costly surprises down the line. Always conduct thorough inspections, review rental history, and research the neighborhood before making an offer. By being aware of these common mistakes and implementing strategies to avoid them, you can confidently analyze rental properties and make sound investment decisions. Now that you understand the key metrics, let's create a simple, repeatable process for analyzing any rental property. 1. Gather property information. Obtain details like asking price, rental income, property taxes, and recent comparable sales. 2. Calculate cash flow. Determine the property's potential cash flow by subtracting operating expenses from gross rental income. 3. Analyze cap rate. Calculate the cap rate to assess the property's potential profitability compared to other investments. 4. Project ROI. Estimate your potential return on investment by considering both cash flow and potential property appreciation. 5. Conduct due diligence. Thoroughly inspect the property, review rental history, and research the neighborhood. And 6. Make an informed decision. Based on your analysis, determine if the property aligns with your investment goals and risk tolerance. By following this straightforward process, you can confidently evaluate any potential rental property and make informed investment decisions. Mastering the fundamentals of real estate analysis empowers you to confidently navigate the exciting world of property investing. By understanding cash flow, cap rate, and ROI, you hold the keys to making smart, data-driven decisions. Remember, successful real estate investing is a numbers game. By diligently analyzing properties and understanding the financial metrics, you minimize risks and maximize your chances of building long-term wealth. Don't let fear or uncertainty hold you back. Embrace the learning process, equip yourself with knowledge, and watch your real estate investment journey flourish. This guide provided a solid foundation for analyzing rental properties. However, the learning doesn't stop here. Continuously expand your knowledge, explore advanced concepts, and never be afraid to ask questions. Network with experienced investors, attend real estate seminars, and stay informed about market trends. The more you learn, the more confident and successful you'll become as a real estate investor. Remember, your real estate journey is a marathon, not a sprint. Embrace the process, stay committed to learning, and enjoy the rewards of building long-term wealth and financial freedom through strategic real estate investments.